Are you tired of being broke despite your best efforts? It might be because of these 10 investment mistakes that are holding you back. Look, I get it. Investing can feel like this big, complicated puzzle, and it's easy to make mistakes, especially when you're just starting out. But the truth is, the biggest difference between those who are winning with their money and those who are stuck in a cycle of debt and financial stress often comes down to a few key things. In this video, I'm going to break down the 10 most common investment mistakes that I see people making. Mistakes that are probably costing you thousands, if not tens of thousands of dollars. The first, and arguably the biggest mistake I see people making, is not diversifying their investments. It's like putting all your eggs in one basket and hoping that basket doesn't fall. If it does, you're in big trouble. Diversification means spreading your money across different asset classes, like stocks, bonds, real estate, and even things like gold or cryptocurrency. You also want to diversify within each asset class. For example, don't just buy stock in one company, even if you think it's the next Amazon. Instead, consider investing in index funds or ETFs that track a broader market, like the S&P 500. This way, if one investment does poorly, it won't tank your entire portfolio. So tell me, are you diversified or are you putting all your eggs in one basket? Let me know in the comments below. The second mistake is blindly following investment trends. You know what I'm talking about. Everyone's suddenly an expert on the next big thing, whether it's meme stocks, NFTs, or some obscure cryptocurrency you've never even heard of. Everyone's throwing money at it, promising you'll get rich quick. But let's be real. How often does that actually work out? Chasing trends is like gambling, and most gamblers lose. Instead of getting caught up in the hype, stick to your investment strategy, do your research, and make informed decisions. Have you ever fallen for a trend? I know I have. Share your experience in the comments. This leads us to mistake number 3, not understanding what you're investing in. Look, I'm not saying you need to be a financial expert to invest, but you should at least have a basic understanding of how your investments work. What companies are you buying stock in? What are the risks and potential rewards? Don't just blindly trust someone else's advice, even if it's your financial advisor. Take the time to educate yourself. There are tons of resources available online and in libraries. The more you know, the better equipped you'll be to make smart investment decisions. So, be honest. Do you actually research your investments, or do you just wing it? Let's discuss in the comments. Mistake number 4 is not having an emergency fund. Listen. Unexpected expenses come up. Your car breaks down, you lose your job, your basement floods. It happens to all of us. Without an emergency fund, these unexpected events can completely derail your financial goals and force you into debt. Before you even think about investing, make sure you have at least 3 to 6 months worth of living expenses saved up in a high-yield savings account. This will give you a safety net to cover those unexpected costs and keep you on track financially. Do you have an emergency fund? Let me know in the comments. Mistake number 5 is trying to time the market. I cannot stress this enough. Trying to predict when the market is going to go up or down is nearly impossible, even for professional investors. Yet, so many people try to do it. They wait for the perfect time to buy or sell, hoping to make a quick buck. But the truth is, you're more likely to lose money than make money trying to time the market. Instead of trying to predict the unpredictable, focus on what you can control. Invest consistently over the long term, ride out the market's ups and downs, and let the power of compound interest work its magic. Have you ever tried to time the market? Share your story in the comments. I'd love to hear it. Mistake number 6 is not rebalancing your portfolio. Over time, your investments will grow at different rates. This can throw your original asset allocation out of whack. For example, let's say you started with a 70% stocks and 30% bonds portfolio. If the stock market does really well, your stocks might now represent 80% or even 90% of your portfolio. This means you're now taking on more risk than you originally intended. Rebalancing involves selling some of your winners and buying more of your losers to get back to your target asset allocation. It's a crucial step in managing your risk and maximizing your returns over the long run. Do you regularly rebalance your portfolio? Tell me about your rebalancing strategy in the comments. Mistake number 7 is ignoring fees. You might think a 1% fee here or a 0.5% fee there doesn't make a big difference. But trust me, those fees add up over time, eating away at your returns and costing you thousands of dollars. Pay close attention to the expense ratios of your mutual funds and ETFs, the trading commissions you pay, and any other fees associated with your investments. Remember, every dollar you pay in fees is a dollar that's not working for you. Do you know how much you pay in fees? Let's talk about it in the comments. Mistake number 8 is letting your emotions dictate your investment decisions. We've all been there. The market takes a dip and you panic, selling everything at a loss. Or you see a stock skyrocketing and you FOMO in, buying at the top, only to see it crash and burn a few days later. Investing based on emotions is a recipe for disaster. Instead, stick to your plan, tune out the market noise, and make rational decisions based on your long-term goals. Have you ever made an emotional investment? Share your experience in the comments below. Mistake number 9 is not having a clear investment plan. Investing without a plan is like setting sail without a destination. You might end up somewhere, but it probably won't be where you wanted to go. Take the time to define your financial goals, your risk tolerance, and your investment timeline. Then, create a plan that aligns with those goals. Having a plan will keep you focused, disciplined, and on track to reach your financial goals. Do you have a written investment plan? Let me know in the comments. And finally, mistake number 10 is not continuing to learn. The world of investing is constantly evolving. New technologies, new trends, and new challenges emerge all the time. To stay ahead of the curve and continue making smart investment decisions, you need to be a lifelong learner. Read books, listen to podcasts, take online courses, and stay informed about the latest developments in the financial world. The more you learn, the better equipped you'll be to navigate the complex world of investing and achieve your financial goals. Are you committed to continuously learning about investing? Let's keep the conversation going in the comments. So there you have it, the 10 investment mistakes that are probably keeping you broke. Now that you know the truth, what will you do about it? The good news is these mistakes are all avoidable. By educating yourself, making smart decisions, and seeking professional advice when needed, you can set yourself up for financial success. Remember, investing is a marathon, not a sprint. It takes time, patience, and discipline to build wealth. But by avoiding these common mistakes, you can significantly increase your chances of achieving your financial goals and living the life you've always dreamed of. If you're ready to break free from the system and take control of your financial future, hit that subscribe button now. Join the Richer Broke community for more no-fluff, actionable wealth strategies every week.